Property, plant, and equipment are long-term tangible assets that are expected to benefit the company for a number of years and are used in its operations. This category can be labeled also as fixed assets, capital assets, PPE. Examples include land, buildings, machines, computers, vehicles, etc. Companies' intent on how the asset will be used is very important. For example, a building may be classified as fixed asset if it's used in the business. It can be classified as long-term investment if it's purchased for speculation and held long-term. And it could be classified as inventory, which is very common for real estate businesses. Fixed assets are recorded at cost. The amount at which the asset is capitalized includes purchase price, delivery, setup costs, testing, and any other cost that prepares the asset for its intended use. As the asset is used, depreciation has to be recognized. Depreciation is a systematic allocation of cost to expense over the useful life. There are three factors determining the amount of depreciation: the acquisition cost, useful life, and salvage value. Useful life is companies' estimate on how long they will use the asset. IRS has published a table suggesting the useful life of various classes of fixed assets. Salvage or residual value is the estimated value of the asset at the end of its useful life, or how much the company will be able to sell it for once it is done using it. The total amount of depreciation that will be recognized over the useful life would equal the difference of the acquisition cost and salvage value, also known as depreciation base. The balance sheet presentation of property, plant, and equipment includes acquisition cost, accumulated depreciation, and book value. Accumulated depreciation is the total amount of depreciation recognized over the asset's life. Book value is the acquisition cost less accumulated depreciation and roughly shows what benefit is left for the company to use in the future years. If the book value is close to its acquisition cost, the asset is relatively new and has a lot more potential left in it. If the book value is close to zero, then the asset probably needs to be replaced soon, and the analyst needs to confirm if the company has the resources to purchase it. Land is not depreciated because it's considered to have indefinite life. There are several established methods of depreciation. Straight line is the most common, followed by double declining balance method. IRS allows companies to develop their own unique method to fit the way they use the asset, as long as they have rationale for it. Straight line method divides the depreciation base into equal amounts over the useful life of the asset, so the annual depreciation is the same every full year. This method is appropriate when the asset is used uniformly over its useful life. For example, a building. Double declining balancing is an accelerated method which recognizes most depreciation in the beginning of the useful life, and then depreciation rapidly declines and recognizes very little towards the end of the useful life. The method is appropriate when the asset's potential is used mostly in the beginning of its life. Just like a computer, when purchased, is fast and powerful, and after time it becomes slow and it is demoted to be used in less important areas of the business. The computation of depreciation was mastered in financial accounting, and I'm not going to spend time on this. The important aspect of depreciation for this course is that the different methods affect differently the income statement and the balance sheet. In the beginning of the useful life, straight line will show higher net income because of lower depreciation expense and higher book value, where the double declining balance will show the lowest net income because of higher depreciation expense and lower book value. As the asset ages, the trend will reverse. However, regardless of the depreciation method, total depreciation recognized over the life of the asset will be the same, and it will equal the depreciation base. After the asset is fully depreciated, the book value also will be the same, and it will equal the salvage value. GAAP requires companies to adopt the method that appropriately allocates cost to the periods benefited. However, straight line method is predominantly used for its simplicity. Gain or losses on sale of fixed assets is computed as the book value is subtracted from the selling price. If the asset is sold for more than the book value, the company will realize a gain. If the asset is sold for less than the book value, the company will realize a loss. Gains and losses on disposal will be reported on the income statement as part of non-operating revenues and expenses. Research in Motion's property, plant, and equipment policy is as follows. We state property, plant, and equipment at cost less accumulated amortization. We do not amortize construction in progress until the assets are ready for use. Depreciation and amortization are recorded using the following rates and methods. Building, leaseholds, and other use the straight line method of depreciation and are depreciated between 5 and 40 years. Cloud operations and other information technologies are depreciated under the straight line method and are depreciated between 3 and 5 years, etc. The term amortization is generally used for cost allocation for intangible assets. Research in Motion uses it in lieu of depreciation. The net amount, property, plant, and equipment, or cost net of accumulated depreciation, as of February 26, 2011, is $2,504,000,000. Liabilities are amounts owed to creditors. Current liabilities are due within 1 year. All other liabilities are classified as non-current. Some liabilities require estimates. Companies offering warranty on its products have to estimate the future cost of parts and labor needed to repair or replace the defective units. This will be reflected in warranty payable account. Companies maintaining a retirement benefit plan that promises payments and other benefits to their employees after retirement would require complex calculations and compliance to estimate and record its pension liability. Income tax payable exists when the estimated income tax payments over the year are below the tax the company needs to pay. Corporations employ various legal strategies to delay as much as possible the payment of taxes, such as using accelerated depreciation. The liability which captures the tax due in future years is called deferred tax liability. Contingent liabilities also require estimation. A contingent liability is either a possible obligation arising from past events and depending on future events that are outside the entity's control. They arise from lawsuits, from dealings with customers, competitors, governmental agencies, environmental cleanup, etc. There are 3 possible scenarios for contingent liabilities. Contingent liability is recorded when it's probable that a loss will occur and the amount of the loss can be reasonably estimated. Probable means that the future event is likely to occur. The existence of a contingent liability should be disclosed in the notes accompanying the financial statements if the liability is reasonably possible but not probable, or if the liability is probable but the amount cannot be reasonably estimated. Reasonably possible means that the chance of the event occurring is more than remote but less than likely. The contingent liability is not recorded or disclosed if in the notes if the probability of its occurrence is remote. Research in Motion's balances as of February 26, 2011 for income taxes payable is $179 million, deferred income tax liability is 0, and income tax payable that is not due in the next 12 months is $31 million. Some of the disclosure for litigation is there are a number of patent disputes with third parties who claim the company's product infringement on patents. And then going forward, the company has awarded approximately $2 billion in past compensation damages. The company has appealed the jury's verdict. And going forward, in addition, the company is subject to legal proceedings, claims, and litigation, and so forth. It is normal for a company of this size to be involved in this type of dealings. Since they may amount to a large amount of money, it is a good idea to check it out in the notes. IFRS Insights. IFRS standards for cash and cash equivalents and accounts receivable are essentially the same as the US GAAP. IFRS does not permit the use of LIFO. Companies use historical cost to record assets under GAAP. IFRS allows fixed assets to be valued at market. Thank you for watching.